One of the biggest problems that we're finding now as crypto traders mature is that many of them are getting divorced and nobody wants to see a divorce. And divorces can get quite ugly and bitter. And typically, one spouse was the crypto trader, the other spouse was not the crypto trader, but thinks that you have massive hordes of money. And despite what you might tell that spouse, they're not going to believe your inventory of coins that you have because it'd be so easy to not disclose everything. So a couple of things happen here. One is during the divorce, let's say the non-crypto spouse will insist on a third-party audit and inventory of all your accounts and records to make sure that the current portfolio of cryptocurrencies that you're disclosing is complete and accurate. So that's one piece of it. And that can be very contentious. What happens during a divorce with a crypto investor is that the non-crypto spouse knows that there's crypto assets and suspects that the crypto spouse is not telling everything, not disclosing all the assets to be divided. And as a result, typically a forensic accounting service is engaged to determine what the current asset holdings are. Well, these forensic services will take the addresses that the crypto spouse tells them about, but then start fishing around for other addresses that have had connections with the addresses that have been disclosed. The intent here is to discover addresses that had not been disclosed. Well, in that process, they may discover transactions and transfers that you may not have wanted to have known, but they're going to discover more things. And it might create a difficulty if the forensic company thinks that a certain address was yours when in fact it was some other entity that you did business with. And then during the divorce, you're going to be treated as though you actually had those assets when in fact they belong to someone else. It just gets complicated and ugly. And this is a big business. It's a different type of service, but I think it may be in one's interest to get multiple opinions if you're not comfortable with the first company's results. Because typically, the company doing the investigation is hired by the non-crypto spouse, which does not have your interests in mind. So you may need to have your own crypto forensic accountant to pit against theirs. It can get ugly and expensive. Another risk, if when you're married and you're a crypto investor, is that it's the natural tendency to file your tax return jointly, both parties on the same tax return, because there are some benefits in terms of reduced taxes that occur when that happens. It's not great, but it's some. And what happens then when in a joint filed return is that the non-crypto spouse accepts legal liability for the accuracy of the return, which includes the crypto reporting. Now, the non-crypto spouse probably has no idea what's being reported on the crypto capital gains, whether it's correct, honest, or complete. It would really behoove a non-crypto spouse to file separately, file your separate tax returns. And a second reason for doing this is when you file separately, the non-crypto spouse is not exposed to any tax liabilities that the crypto spouse might be causing because he failed to report correctly. This would be very important if you got a divorce. Then you're, as a divorced spouse, also are separated from all your partner's past tax improprieties. So, really, if you're a crypto investor, you should file separately. Well, what about those savings? You need to count those joint file savings as not worth the savings to take those. You might be saving a quarter, but spending $1 later. So be careful. I highly recommend people file returns separately. But the bigger problem lies beyond that. Here's where it is. So in a divorce, if you were to split assets, the cost basis of those assets also transfers to the spouse. So when you define what assets are being transferred to the non-crypto spouse, you have to define what the cost basis is of those assets that are being traded. Now, you're buying things and trading things, so you might have some Ethereum you bought at one price and some Ethereum you bought at another price, and there might be arguments in the divorce settlement as to which Ethereum are the ones being transferred to the spouse. You can see it gets ugly. Here's the hidden problem behind that, if you will. So the spouses have split their assets and split their cost basis, but now, assuming the non-crypto spouse took some of those assets, then she's going to have to report that on her tax return. Now, the non-crypto spouse is completely in the dark in terms of the tax reporting obligations of a crypto trader, just not involved, not interested, not understanding, and going to make mistakes when they start to file. Maybe the first thing that spouse does is sell all the assets, unaware that there's a massive capital gains that she's going to have to pay later on when taxes are due. So you can see, and that could be a giant nightmare. It could be very explosive and reawakening legal issues in the divorce. But the deeper pain is that an incorrect filed tax return would open up the, let's say, one or both partners to IRS audits. Because once they go in and discover some irregularities on one, they will then maybe spread the audit into the other partner. So now both partners who have taken a couple years to fight to divorce themselves are now in a similar boat, actually being pitted against each other by the IRS. I think the smartest thing to do there is to really seriously look at it. This is a powder keg in terms of splitting the assets. It'd be smartest if the second spouse accepted what was the final determination for the portfolio assets and just took a cash distribution rather than taking any of the assets themselves. Because it's the moving of assets that are going to intertangle your cost bases between the two partners, and that's going to create severe ugliness in terms of long-term exposure to risk by the IRS. So I think it's far better if you're in that situation to persuade to have a cash distribution of the crypto values rather than to try to split the coins parties. The way we could help at CryptoTaxAudit is we could take the inventory of coins that's been done by a forensic company, and then we could calculate the remaining tax basis on these coins. The reason that we don't do the whole forensic audit is it's a different focus. It's a different set of tools that you're going after to, explore the blockchain and find connections. Whereas our focus is more on tracking the cost basis. And the forensic accountant is not really tracking the cost basis as much as they're trying to find the coins. So once there's agreement in terms of where the addresses and the coins are, then at CryptoTaxAudit, we could do the crypto gain calculation. We could do a point in time fixed inventory and what the cost bases are of our inventory. So with CryptoTaxAudit, think cost basis. Because when you, during a divorce, transfer some of your coins over to a spouse, you are also transferring cost basis. During a divorce, if you're not transferring the coins, then you're going to have to liquidate a lot of coins and you're going to have to calculate the cost basis because the spouse has to participate in paying for the sale of those coins. So you need to have a authoritative, reliable source who can give you an exact capital gains calculation number, whether you're dividing or not dividing it in a divorce. The reason cost basis is important in a divorce is because there's a gain. How much is there a gain that the person made? And that might be part of the assets that are being transferred. Secondly, it's the tracking of the cost basis and the legal obligation for who has responsibility for paying for that gain. You want to have an exact calculation. The forensic accountant firm may have an opinion, but they are not specialists in gain calculation, which is what we are. It's two different skills, and it's very, very, very different. Marriage is a beautiful thing. Divorce can make it really ugly.